Hello everyone, and welcome to the latest edition of our Global Outlook. My name is John Ferguson, Director of Global Forecasting and Country Analysis here at the EIU, and today I'm joined by Cailin Birch, our Global Economist and Lead US Analyst, and Felix Delbruck, our Country Risk Service Director. Welcome to another video. Today we want to walk you through three really important forecasts that we think are both in the news right now but will also have a significant role to play over the next few weeks and coming months. We want to talk to you about a significant change in our US monetary policy forecast, as well as Venezuela, and finally we want to talk about the outlook for US foreign policy. Felix, let's start with the Fed, if we can. Now, the Fed sort of shocked a lot of people, including us, at their latest monetary policy meeting in late January, where they basically signalled that even though further rate hikes might not be completely off the table, that they effectively were put on hold. What's going on here with the Federal Reserve and monetary policy there in the US?
Right, so we've been expecting the Fed to become more cautious this year for some time. The US economy is slowing. We're expecting it to slow further over the next 2 years. But I think the Fed moved quite a bit faster than we were expecting as well. So we were surprised as well as others. And to explain why we were surprised, when we looked at what the Fed was saying, the commentary around this change, they haven't really changed their central forecast for the US, so they're still quite upbeat. What they were reacting to were all kinds of risks around the horizon, so things like
market volatility as well.
Market volatility, business and consumer confidence, the government shutdown, the US-China trade war, what was happening globally. So we were thinking that they'd want to wait for a bit more evidence about what that meant for US growth than they seemed to need.
And they were talking about being data dependent too, of course. They were using that phrase a lot.
Exactly, which they still are. So there is still a chance that they could be on pause for a while and then hike again. We think that at this stage that's quite slim.
And that's a change to our forecast.
So we were saying a month ago that they'd probably still hike another 2 times before pausing. Now that just seems quite unlikely because given our overall view of where the US economy is going, it is slowing. We're quite pessimistic on the US-China trade war. We're expecting things to slow further by the second half of this year. It's just hard to see the Fed regaining its appetite for hikes.
Absolutely. So that is a pretty important change to our US monetary policy outlook. Cailin, let me bring you in here. We are pretty pessimistic now on growth and also the Fed. What does this mean for our outlook for US growth?
Well, actually, we've maintained our forecast for U.S. economic growth in 2019 of 2.3%. And the reason that we kept it stable was because we now have a more cautious outlook from the Fed, because we brought down our forecast from 2 to 1 and now 0 likely rate hikes, with the continued possibility, but baseline scenario being probably no rate hikes this year as the data softens again even further later in 2019. That stance will give a little bit more of a boost to the economy than we had envisaged when we were expecting rates to be higher. So there are a number of factors already that are weighing on our expectation for economic growth in 2019. And at 2.3%, our forecast was, in a sense, well below market consensus already at that point. Because really we saw a variety of factors. One being slightly weaker consumer sentiment as the US-China trade war started to feed into, in many cases, higher import prices. We do expect another wave of tariffs in the next few months as the US-China trade talks don't result in sufficient progress, a bit of progress, but not enough to allow the U.S. to back down from its earlier threats. And those higher costs of, in many cases, consumer goods, but also the tariffs we've seen put on in the last year trickling into higher costs for everything from baseline home consumer goods to automotives, etc. Oil prices will be lower than they were in 2018. That'll give a little bit of a boost. But on the whole, there's nothing that's going to, kind of give a stimulus to consumer sentiment.
Right.
Certainly not in the context of a trade war. And businesses, we think, are going to be feeling it even more so. So again, one of the reasons that the Fed has changed its language around the possibility for future rate hikes is the fact that they're now citing even more than they were, say, like October, November last year, the weight that will put on business activity as they're facing higher input costs and weaker external competitiveness as a result of these retaliatory tariffs that not just China, but also the EU and Canada and Mexico have all put on and maintained on U.S. goods.
Right.
So there's a lot of things trickling into the U.S. production, manufacturing, and consumer factors that all mean that it's unlikely we'll see growth like we did last year. We also have to remember that the tax cut that was approved at the very end of 2017 gave a bit of a sugar high to the economy in 2018.
And that's running out.
That was a temporary effect, and it's running out. So we won't have the added kind of stimulus from that. And essentially, there's just nothing pointing to much faster growth this year.
And we should also mention the shutdown. It was the longest in history, and that's not a good story for economic growth. So that's yet another factor.
This actually is what's balancing out the now slightly positive boost that we're getting from a more cautious Fed keeping rates on hold. Is in fact, we would have considered lowering our GDP forecast in the context of the shutdown without that added kind of support, if not stimulus, but support from the Fed. And that's because a lot of the government shutdown went on for 35 days, by far the longest shutdown. We saw kind of a plummeting in consumer sentiment in January, down by more than 5 percentage points over the course of the first 2 weeks of the month, which is the sharpest decline we've seen in more than a decade. None of that spells strong economic activity.
Right.
800,000 workers going without pay, some temporarily, although there's some question marks about when that back pay is coming through. So a lot of the negative impact will be concentrated in the first quarter, and some of those foregone government and consumer spending plans will be made up later in the year as we see pent-up demand coming out. But there'll be a segment, even the U.S. government has estimated about kind of $3 billion of the $8 billion in foregone economic activity won't be recouped over the course of the year, just because it's impossible, because it went on so long to recoup all of that private spending. So it would have been lower, U.S. GDP, had it not been for a slightly lower now interest rate forecast that should support a little bit of that consumer spending. But it's not the positive year that we had in 2018.
Right. So we're going to hold at 2.3% US growth for this year. Felix, what does this mean for the dollar and emerging markets?
Right, so if we cast our mind back to 2018, of course everybody was talking about a looming emerging market crisis on the back of the strengthening dollar and rising interest rates from the Fed. So in the context of that, the Fed being a bit more cautious is a welcome, it gives emerging markets a welcome breathing pause, breathing space. But emerging markets aren't out of the woods. So a lot of the vulnerabilities that were there last year, jittery markets, a legacy of taking on debt, vulnerability to things like falling commodity prices, that's all still there. So yes, a lot of emerging market currencies are stronger now than they were back in September, but there are still other risks out there. So we actually still think that the risk of an emerging market crisis is moderately high over the next 2 years. It's just less likely to be triggered by a further rise in the dollar or more rises in US interest rates.
Absolutely. So Felix, sticking with the emerging market theme for a moment, Venezuela. It's been a major story recently. I'm sure everyone around the world has seen it. There's a possibility of regime change. What's going on there?
Before I get into the here and now, just two important things to remember about Venezuela. So on the one hand, the economic crisis of Venezuela is very real. We all know about hyperinflation. We don't know what Venezuelan inflation is because the government doesn't publish it anymore, but it could be as high as 1 million % a year. We know about the food shortage.
Extraordinary.
But on the ground, what that means for ordinary Venezuelans is food shortages, medical shortages. We don't know how many people have left. Again, the data is a bit murky, but it could be millions of people who've moved to surrounding countries, which has been a major problem for countries like Colombia.
Right.
So that's the situation on the one hand. And on the other hand, you've got the military that's still
plays an incredibly important role.
Increasingly so. So the Maduro regime is basically now being propped up by the military. It's essentially a patronage system where money gets distributed to key military people in return for their support. The state oil company is run by a military person. It's probably one of the reasons why oil production in Venezuela is at its lowest level in decades. But key regions are being basically run by key military people as well. Right. So you've got a really serious situation economically. powers and control of the military, something's got to give. And so we've been thinking for a long time that there had to be some kind of a regime change. I guess what's happened in the last couple of weeks is a bit more sudden than we might have expected.
Right. So what happens now?
Yeah, so what's happened is Juan Guaidó, the leader of the opposition in the National Assembly, that's the legislature that was stripped of its power in 2017, he's declared himself interim president. He's garnered a lot of support internationally, more than 50 countries, including the US. He's garnered a lot of support domestically as well. Really importantly, the US has declared sanctions on Venezuelan oil exports. So
that was a major card. That was a major card.
Well,
they could have taken smaller steps, but they played one of their biggest cards.
Well, that's essential because that potentially chokes off that flow of patronage money that keeps the Maduro regime going.
Yeah.
So
that's a
very big move, but the military has yet to shift its support away from Maduro. Yes, there have been defections, but at the senior levels, they're still backing the regime. And very importantly, China and Russia are still backing the regime as well.
Right.
So in terms of what happens next, we do think that the most likely scenario is a transition government. Maduro and some of his key people go, but there's an amnesty for many other figures who were implicated in the regime, some transition government involving the military, but eventually you move towards fresh elections and a clean-up of the electoral system. So sort of continuity, sort of change, a compromise solution. Unfortunately, there is still a major risk, though, that the government digs in its heels. Why should they trust these promises of amnesty by the opposition, particularly when some of them have been accused by the US of things like drug running or weapons trafficking? So there is still this incentive to stick with the devil they know and to dig in their heels. And how long that lasts? Well, that all depends on what China and Russia do. How much money are they willing to put forward to keep this regime afloat, and for how long? And that's the big unknown. So that's what we're watching.
Great. And I think it's important to note that I think you're right to point out China and Russia. I think we're clear on the US's position here. Both Mike Pence and John Bolton have referred to Venezuela, but in terms of these phrases, a troika of tyranny and a wolf pack of rogue states, which I found quite intriguing. And Venezuela is in both of those groupings.
Paints a picture.
So there's only one clear direction for US foreign policy on Venezuela, but as you say, Felix, it's the role of China and Russia that we'll keep a close eye on. Cailin, can I bring you back in here and talk about what does this mean for oil markets? There's a bit of uncertainty here around the role of Venezuelan oil and Venezuelan exports, but what does this mean for the oil market?
Right, well, you rightly mentioned that Venezuela's oil production hasn't fallen just in the last couple of months. It's been falling for quite some time, and it's now down to what would for Venezuela essentially be a historic low in kind of the modern era. It's had some ups and downs over the past 40 years, but this is a low point, definitely. They're at about 1.2 at a max million barrels per day, when they were up at about they were well above 2 just a couple of years ago.
Right.
So this is very dramatic for the regime, again, because they rely so heavily, almost exclusively, on revenue from PDVSA, the oil company, and from the industry more broadly. Now, Venezuela is not the biggest OPEC producer, but it is a significant OPEC producer, so the loss of Venezuelan production is significant to the market. The fact of the matter is, though, it's been dropping out for so long, and it is now essentially at kind of the bare bones. It's unlikely...
So it's already been priced in.
It has been priced in. It's unlikely that Venezuela's oil production would fall much down below the 1 million barrel per day mark, because that is kind of the essential kind of fields that will continue to function because they're under military and PDVSA control, and in some cases foreign investors that have carved out kind of a clear operating sphere and they're less kind of impacted by the political volatility. So the market's really used to it. This was something that contributed to price spikes that we saw over the course of 2018 as Venezuela's kind of threshold was really, they crossed that threshold very sharply. And now I think probably there's some concern around what's happening next, particularly because there are foreign actors. We don't know what Russia and China will do, how long the crisis will go on, what that means. But in terms of Venezuela creating an oil supply disruption, that's unlikely. Now, one thing to consider that could threaten that 1 million barrels per day is that Venezuela relies on imports of other fuels to dilute their very heavy crude, which is necessary to get it through pipelines and to port for exports. they had previously relied very heavily on the US for those fuels, purely for dilution. That avenue is now closed, and they're going to have to find those fuels somewhere else.
Right.
The EU could provide them, but because anyone that is involved in the US banking sector is touched by those sanctions, that's an unlikely avenue. So again, it becomes a major Russian and to a secondary extent, maybe as a go-through, a Chinese issue, how long they can rely on the international community for support. That's the major question mark, and we'll be keeping an eye on it.
Okay. What about the prospect of regime change? What would that do to the oil price, the oil market outlook? Is there a potential upside there if things were to change?
Well, given the support that we've seen in the international community for the opposition leader and the fact that the opposition government that would now like to take over would presumably have much better access to international financing,
right,
we would potentially see an improvement in Venezuelan oil production.
bringing some of it back online into the export markets.
Yes, depending on how quickly they could root out corruption in the oil sector, knowing that is the most difficult area to root it out because it is so firmly ingrained. But with a new government in place, and if they were able to kind of enact that change and to a certain extent reduce the military's role, make sure PDVSA and most importantly foreign partners in the sector are able to operate in the medium term, wouldn't be a 2-month turnaround, but in the next few months that could lead to an improvement in Venezuela's oil. They have the potential to produce a lot more. It's really the political and diplomatic context surrounding it that's limiting the country. So a new government could actually boost production, and that would push prices downward as we face yet another source of more supply than we had expected.
Okay, fascinating. Okay, let's broaden it out now to US foreign policy more generally. Obviously, we sort of know the position of the US in relation to Venezuela, but what's your outlook for US foreign policy this year?
Well, it's only been a month and a half into 2019, and so much has happened on the foreign policy side. Venezuela was a big move, as you said, playing kind of the oil sanctions card was effectively the most dramatic non-military option that the US had to play. That was a very strong kind of movement from an administration that thus far has been very hesitant to get involved or even remain involved in existing kind of partnerships or military operations abroad. So we've seen this kind of growing isolationism, and Venezuela was one kind of departure from that. More broadly, though, the isolationist stance continues. So we actually saw at the end of last year, President Trump announcing that we'd be withdrawing U.S. troops from Syria, which was a very stark reversal from kind of the coalitions that the U.S. had initially helped to build and then certainly to maintain with international partners to maintain a presence in Syria, kind of really unilaterally withdrawing. According to that statement by the president, there was then a subsequent measure to withdraw U.S. troops from Afghanistan, a very separate conflict, very different set of circumstances, but still a very kind of notable departure at a time when the conflict is not showing any sign of real resolution. So this, I think, is part of Mr. Trump's America First, bringing U.S. troops home, not necessarily engaging with U.S. allies just to maintain partnerships that exist, but doing whatever seems to be in America's interest primarily first. Interestingly.
But also in his view.
Yes, in his view, which notably there's quite a departure between his view and the view of the intelligence community and the defense establishment in Washington. So there is a departure there. And remarkably, for the first time really that we've seen in the last 2 years under this administration so far, we've seen the initial kind of signs of cracks between Mr. Trump and the Republican and, to a certain extent, defense establishment over these foreign policy decisions. Again, the defense review that came out earlier this year clearly identified North Korea as a severe threat to the U.S., continuing to be so, despite Mr. Trump's very different view of kind of the peace process that's going on and so-called promises made by the North Korean regime. The same with the continued threat of ISIS in Syria and the broader Middle East, which is very different from Mr. Trump's view. And that conflict has actually prompted congressional Republicans to publicly break with Trump. And we saw a measure passed as part of a broader Middle East policy bill that directly contradicted. It's a non-binding measure. It doesn't change Mr. Trump's strategy, but it's a direct contradiction of what he sees as the main security threats and also what the U.S.'s role is more broadly. That measure kind of maintain support for supporting U.S. allies, leading internationally, etc., the more traditional Republican views. The fact that we saw that fracture, the first really public one between congressional Republicans and Trump now as we're heading into the campaign period for 2020 is significant. They've been too hesitant to do that previously, and the fact that they're willing to so publicly say it may show that we're starting to see a bit of a divergence there between the establishment and their candidate for 2020.
So just pick up on that last point there. What does that mean for his Mr. Trump's potential re-election in 2020?
Well, we expect that Trump will maintain this America First kind of unilateral, growing isolationist view to foreign policy. So now that we've seen some clear signs that really flies in the face of traditional Republican foreign policy
Right.
and what their priorities have been, we see this as kind of the first opening between the two, and really like letting any daylight in between Trump and congressional Republicans, considering certainly that Democrats, at least thus far, have proven to be able to pull together a very united front in Congress, at least. An election is a different thing. But that growing divergence will be a concern to the extent that, Trump will maintain his core support base. They have been fairly resolute over the last 2 years,
Yeah.
but he will depend on the rest of the Republican establishment to support him. If that support is weakening, that'll be a risk for him.
Absolutely, absolutely. Cailin, thanks so much. Let's leave it there. Cailin and Felix, thanks so much for your insight, as always. And thank you all for watching. Again, depending on where you get your EIU content, head to eiu.com. You'll see free articles, but also other ways of accessing our content. But also check out the Twitter feeds of our various analysts, including Cailin and Felix and other analysts around the world. But thank you so much for watching. We'll be back next month with another update of our global outlook.